All right, you might think you've got a pretty good handle on how the global economy actually works, right? Well, there's actually a completely invisible layer pulling the strings behind the scenes. In this explainer, we're going to uncover the exact quiet financial mechanics that determine if cargo moves, if oil flows, and ultimately what you end up paying at the grocery store.
So, who actually calls the shots? When we ask who decides if the global economy is truly open for business, you'd probably guess it's world leaders, presidents, or politicians making these grand declarations on the world stage. But the reality? It's way more hidden than that. Honestly, it doesn't actually matter what governments declare if the underlying financial mechanics aren't in place.
Check this out. It's actually these obscure underwriting syndicates, places like Ascot, Hiscox, Beasley, and the International Group of P&I Clubs. I mean, you've probably never even heard of them, right? They don't hold press conferences, but they literally hold the keys to international shipping because the entire global shipping industry runs from top to bottom on insurance. Here's how we'll break down this massive, invisible risk architecture today. We'll cover the invisible gatekeepers, how shipping insurance works, the shocking war risk premium, why peace declarations fail, the global price cascade, and finally, we'll follow the money. All right, let's jump right into Section 1, the invisible gatekeepers and the power of underwriters.
So, war risk insurance. This is essentially the ultimate bottleneck of global trade. Simply put, if a Lloyd syndicate decides they won't write this highly specialized policy for a designated conflict zone, that ship is not sailing. Period. It's a hard stop. The cargo doesn't move, and the oil stays exactly where it is. These specialist underwriting groups are the ultimate gatekeepers.
Moving along to Section 2, how shipping insurance works, specifically looking at the mandatory layers. Every single vessel that transits a major choke point, like, say, the Strait of Hormuz, absolutely requires all three of these mandatory layers. You've got your standard hull insurance, your cargo insurance, and war risk insurance. But here's the kicker. Right now, a lot of basic hull insurers have just flat out excluded the Persian Gulf entirely. So you are completely forced to obtain that third layer of war risk insurance, or the journey is functionally impossible. Which brings us to Section 3, the shocking war risk premium, or basically repricing the ocean. Now, focus on this because the economic impact here is absolutely wild. Before the conflict, the war risk premium was essentially a rounding error. We're talking maybe 0.01% of the ship's total hull value. Today, depending on the insurer, those premiums have skyrocketed to between 2 and 5% of the hull value per transit. That is a staggering 500-fold increase. It takes this tiny, negligible expense and morphs it into a massive, sometimes insurmountable financial wall. Let's put those percentages into actual dollars to really see the impact. $4 million to $10 million. That is the war risk premium alone for a single very large crude carrier carrying $200 million of oil, just to make one single transit. That's the premium for one trip. When you multiply that massive cost across the entire global fleet, the economic shockwave is enormous. And because those basic hull insurers are dropping coverage left and right, ship owners are totally backed into a corner. You have to go to a specialist Lloyd syndicate. And honestly, that's only if you can even get them to cover you in such a volatile environment. If their risk models say the danger is too high, no amount of cash is going to buy you a policy. All right, Section 4, why peace declarations fail. Reality versus rhetoric. You know, politicians can post on social media all day long. Leaders can loudly declare that a strait is safe, or open for business, or that we've achieved peace. But the insurance market, it doesn't care about political rhetoric. It models cold, hard data. While governments are busy declaring peace, the actual market reality is vessels refusing to sail and insurers actively denying coverage. The market simply says, yeah, not so fast. When those underwriters at Lloyd's are staring at their screens, they're not reading political tweets. They are looking at a genuinely bleak set of real-world conditions. We're talking uncleared ocean mines, an active naval blockade, actual ship seizures happening right in the middle of a supposed ceasefire, plus air defense activations and global oil sitting above $100. They price their policies based on this exact data, which means they price in continued conflict completely regardless of what any government claims. This quote from an oil market analyst absolutely hits the nail on the head. Ship owners are hesitating, and for good reason. No one wants to be the guinea pig testing the waters with a multi-million-dollar vessel and a massive specialized premium attached to it. It literally becomes a high-stakes game of maritime chicken. Who is actually brave enough or crazy enough to go first? Let's move to Section 5, the global price cascade, from oil to food.
Watch how this domino effect actually builds, because this directly hits your wallet. First, those war risk premiums rise. That forces an immediate spike in overall shipping costs. Those higher shipping costs, they drive global oil prices straight up. Then, that expensive oil drives up manufacturing costs everywhere. And finally, all of those compounded costs land right on the consumer, making everyday food prices jump. It's a direct, unbroken sequential line from geopolitical friction all the way down to the grocery store aisle.
Think about it like this. A premium, mathematically calculated by some specialist sitting at a desk in London, directly and measurably transforms into a price increase for a family buying basic food at a market in Lagos. This insurance industry is literally the ultimate transmission mechanism between global geopolitical risk and your daily inflation. Which brings us to our final part, Section 6, Follow the Money, the ultimate truth. Right now, the mutual insurance groups, known as P&I clubs, the folks who cover ship owner liability, are issuing some incredibly cautious guidance. They are forcing mandatory conflict zone notifications and demanding entirely new extra premiums just to enter the Persian Gulf. What we're witnessing here is the entire risk architecture of maritime trade being repriced in real time. That signals to everyone that the danger is far, far from over. So here is the big takeaway. The insurance industry is arguably the most powerful, yet least visible actor in this entire crisis. They don't get a seat at the diplomatic negotiating table, they don't hold televised press conferences, yet their quiet, calculated math absolutely determines whether a massive global choke point like the Strait of Hormuz is functionally open or closed. So if you really want to know the true status of the global economy, the question's pretty simple, right? Are you going to listen to the politicians declaring that everything is fine, or are you going to follow the money? When you want the actual truth about global trade, listen to Lloyd's, because they're the ones with actual money on the line. So what geopolitical choke point do you think these insurance syndicates are going to reprice next?